Altitude impresses, but the air thins as you rise. For Sta Lucia land, the first quarter of 2026 brought a balance sheet that remains vast and land-rich. Yet its core challenge persists: a rising mountain of inventory, thinning cash, and delayed debts. Demand is still soft, but in a twist, the company delivered higher margins thanks to more profitable project sales. Net income edged up to 949 million pesos from last year's 938 million pesos, despite total income shrinking to 2.47 billion pesos. Certain theme: Lucia squeezed greater profit from a smaller revenue base, an admirable feat, though not one to rely on every cycle. The inventory mountain grew further. Real estate stocks rose to 44.3 billion pesos, accounting for 61% of total assets. For a developer, inventory is more than stock. It's future promise or unproductive capital, depending on demand. Sta Lucia's land bank gives it heft, but absorption remains the challenge. Buyers are still hesitant. The mountain is tall, but there are fewer climbers. Top-line figures show softness. Real estate sales dipped slightly, commission income nearly vanished, and other revenues fell. Leasing, however, provided a rare bright spot. Rental income rose 11%, driven by new mall developments. This increase is strategically useful, smoothing the volatility of property sales. Yet leasing remains a small part of Sta Lucia's overall income. What truly saved the quarter was improved margins. Cost of real estate sales dropped sharply, allowing gross margins to expand from 79% last year to 84% now. Selling and administrative expenses fell as well, offsetting weak sales and lifting pre-tax income. But margin-led resilience is not demand-driven growth. Sustained improvement requires both volume and strong margins. Sta Lucia proved the latter, but the former remains elusive. Cash, the oxygen for any climb, declined 18% to 2.07 billion pesos. With over 10 billion pesos in near-term debt, flexibility is tight, despite a modest improvement in accounting liquidity. Debt maturities were pushed outward, with short-term borrowings reduced and long-term debt increased, a prudent move but not true deleveraging. Interest coverage improved, indicating safer breathing room, even as finance costs grew. Operating cash flow strengthened materially, but underlying concerns persisted: rising inventory, falling cash, stagnant demand, and collapsed commission income. Sta Lucia's quarter was not a summit, but a ledge, a pause, offering firmer footing, but still facing a steep climb. Investors are left watching for renewed demand, knowing that the inventory mountain could either become a reservoir of future earnings or a test of patience. Margin gains give hope, debt reshaping provides stability, but the climb continues, and more climbers are needed for true ascent.